We are enjoying a stock market with rising stock prices overall for year to date of 2023. The last 3 weeks have really taken a break from those upward price increases. Last 3 weeks, the S&P is down 4.78%. I actually think it's a good thing. And a stock market cannot continue to rise indefinitely. The stock market would be broken and we would have a severe correction in store in the future if we just kept going. Instead, we had this pullback, which I think is a good thing. The stock market taking a break. Certain stocks have become, I think, more interesting. I think they have better discounts and are worth taking a look at to buy shares. And some stocks have stayed in the, I think, overpriced range. And it's really up to the investor to find, the good values out there and invest in the right ways. Let me take a look at the stock market and share with you what I'm seeing and what I expect for the remainder of this month, as well as the remainder of 2023. The stock market year to date is up 14.27%. And that's really good we haven't even completed 8 full months. And the return there, if we annualized it, it'd be 21.8%. That's a very good year in the stock market. I'll take it, especially after having just a terrific run. If you look at where we were in the late March timeframe to where we got to at the very end of July, that was a great run, great appreciation in stocks, and it was a lot of fun to watch. Now, all parties have to come to an end, and really right around the end of July, beginning of August, we had this just downward pressure on stock prices. I sold off some of my stocks. My biggest position is Meta. I took 6% of my position and sold it. I took a part of my position in Google, sold it. And I can go across the board. Airbnb. These are companies I want to own forever. But after seeing such a rise in the stock market, I just saw that, hey, that's not sustainable. So I wanted to pull back some of my shares so I can have that cash, expecting that, yeah, we'll have a pullback and then we'll have discounts in stocks where I could take advantage of better pricing and average in a very good share price. So that's what I'm seeing in the market. And let me get into additional analysis that I wanted to share with you. So the stock market, if we annualize it, we'd be at a 21.8% annualized return. And that's a really good return. We're down almost 5% in the last 3 weeks. Very good, healthy pullback. Now, 3 weeks ago, if you look on my videos, you would see that I showed this exact chart. And I looked at historically the last 28 years. At that time, 3 weeks ago, the return would have been above 30%. I think it was 33% annualized return. And there's only 2 years where the returns were better than where we were tracking at an annualized basis 3 weeks ago. That was just really hard to fathom that we were just going to kind of establish the best year or close to the best year in the last close to 30 years. So the pullback is quite expected. And now that we have prices that have come down, you have a market where actually 10 years out of the last 28 years have been this good or better. So that's, I'm feeling like this is a little more of an up market. I think it's expected because 2022 was a down year. It was down significantly, I believe like 22%. And now we're seeing a bounce back from that year. We have some good things behind us, like earnings have been good. I think the climate has been good. AI really fueled some stocks. So I'm feeling like, hey, this market now is more sustainable. It's more sustainable. And I think we could hit the low 20%, return for the year, maybe a little bit better, maybe a little bit worse. Now I track the Magnificent Seven stocks, which are the 7 biggest stocks in the stock market that have really been moving just dramatically this year. And the 7 stocks are Apple, Amazon, Nvidia, Tesla, Alphabet, Meta, and Microsoft. And these stocks, although they're doing great this year, you've really seen the pullback in these stocks as well. For example, Apple is having a great year. It's up 39%, but it has had a pullback more recently of 11%. You look at Amazon. Amazon had a great month. They had really good earnings. It's up 55% for the year, but it also had a pullback of 6%. Not as bad as Apple. NVIDIA, really impressive that they have held a lot of their gigantic gains in 2023. They are up more than 202% year to date. That's incredible. And they've been able to hold on to those gains, which is really incredible. Now, Tesla's probably the one that's lost the most value. It's down almost 20% in the last month. They are still up for the year to date of 99%, but boy, that's a pretty good pullback, almost 20%. Alphabet's really held their gains as well. That's really been good to see. Now, I would say that Alphabet was kind of lagging the Magnificent Seven, but now they've caught up and they're kind of holding on to their gains. Meta's had a terrific year, up 127%, but in the last month, it's pulled back 13%. I'm currently buying more shares of Meta because I think they're discounted and it's a good acquisition price. Microsoft has had a terrific year, up 32%, but it's down close to 10% in the last month. So you can really see the pullback in the Magnificent Seven. The Magnificent Seven are so important because they make up more than $10 trillion of market cap. The whole S&P, that's 500 companies, right? That's 493 more companies than the Magnificent Seven. Altogether is 36.45% trillion, 36.45 trillion. And the Magnificent Seven make up 27.5%. So when the Magnificent Seven, go down, the whole market's going to go down, obviously. And this is kind of each company at a time, how we've seen the stocks pull back. And I like tracking this because it opens up opportunities like buying more shares of Meta, buying more shares of Alphabet, and looking at other of these Magnificent Sevens to buy additional shares in. 3 weeks ago, I did a video on the Magnificent Seven, and the numbers were quite different. The actual overall value of the Magnificent Seven was much higher, and they represented a bigger percentage of the S&P. Their 11.48 trillion was the overall value of these stocks, and they represented 30% of the S&P. But if you fast forward just 3 weeks, the Magnificent Seven have dropped $1.46 trillion in value, in market cap. That's a big drop. You have a 2.5% drop in share of the Magnificent Seven. They were 30% of the S&P 500. Now they're 27.5%. And overall, the S&P has changed. It was 3 weeks ago, the S&P was valued at 37.84 trillion. But now it's 36.45. And what that leads me to believe is the Magnificent Seven are awesome companies. And where possible, I like to buy them at a discount and then hold them and then sell them at a premium. Frankly, I've sold Amazon at a premium, Apple at a premium, NVIDIA at a premium. I sold Tesla at a premium, and I sold Microsoft. I've made money on all these shares. But I also see that the smaller cap stocks may be giving us a better opportunity to buy into companies that can give us better value propositions. So I'm seeing that in the market. I'm glad that we have a pullback in stocks, which opens up opportunities to buy stocks at a discounted price. So 3 weeks ago, I showed this slide in the video I recorded at that time. And I stated that, hey, the market was just too greedy. It was a little too, euphoria, exuberance in the market. We were riding this momentum. I think the momentum was kicked off by AI, which I think AI is going to be really interesting in the future, but we just don't know enough. We don't know who's going to be a winner or a loser, which company is really going to thrive in the AI era. And are we, within a year or 2 or 3 years before real business, is getting done on AI? We don't know. So if we don't know, we have to deal with facts, and the facts really come out of the financial statements with companies. We really look at how companies their business models and how profitable and how much free cash flow companies make. So now we have more fear in the market, which is good because fear will cause a lot of value investors like myself to really study a little harder, really analyze companies a little closer to make sure I'm making a sound investment. And that apprehension is going to drive prices down, which is good. It's good that way prices just don't get out of hand. And next thing you know, you have a big correction in a stock or a big correction in a market that takes a long time to recover from. So it's good to have a little fear in the market. It's good to have these prices come down. And I'm seeing more prices on stocks. Like I think I mentioned Meta. I'm buying into Meta because I think it's discounted. And I think over the long haul, it's going to be a good purchase for me. Certain prices are coming down to a point where I think it's a good buy. So the macro forces that are going to cause the market to go up or down, just the ones that I'm seeing, first, if the earnings reports have been good, they have been better than I expected. I thought this would be a down year for earnings, but, I would say 80% of companies have had good earnings. Some of them had great earnings. Like, for example, Amazon had great earnings. Google had very good earnings. So a lot of companies are reporting good earnings. And I think that could really cause the market to go higher because people are going to see that, hey, these are really valuable businesses and they're operating really well. Interest rates are expected to stop increasing, and we don't know when they're going to start to decrease. But if they could just stop increasing, I think that would give the market the signal that it could start going up again. And especially if we have a soft landing expectation. And it's setting up to be a soft landing. I'm not seeing just drastic unemployment. Unemployment really isn't a factor right now. There's lots of jobs out there. There isn't a real big, recessionary kind of climate right now. It's actually setting up to be a soft landing. Now, things can really change, and factors that can push the market down is if that expectation of a recession changes and it becomes a hard landing. Like all of a sudden, there's a lot of unemployment. All of a sudden, there's a big contraction in spending by the consumer. Those things can really cause the market to go down and go down significantly. And if we have higher interest rates, now the Fed has been what they say hawkish, which is, I would say, they're really playing tough on interest rates and raising them. And they have said that they'd rather make a mistake by raising them too high and therefore pushing down inflation rather than not pushing hard enough and then inflation goes up. So if they push harder and they raise interest rates a little bit more, like two more, 25-point rate hikes, that will force the market down. It'll just be so darn high that buying bonds is just going to become too attractive. A lot of money is going to leave stocks and go over to bonds because it's a lower risk proposition with a very good return. Right now, you can find bonds well over 10% that would have what I believe is similar risk to a stock. Well, that's a pretty strong proposition right now. If it got even better where you're making 12, 14% on a bond, boy, that's tough to turn down. And the last thing is, not sure how much it's going to affect 2023, but there's an election year coming. And election years tend to make, I think, investors a little more concerned. I think we generally get rattled because there's a lot of claims that go around. There's a lot of, press headlines that look pretty darn crazy. and politicians have to do that in order to get elected. But sometimes they come out with some things that really rattle the economy or rattle the markets. So I would say with an election year coming, I think a lot of investors are going to stay put and maybe not invest as aggressively as they would in a year that didn't have an election involved. So the market is offering up really good values to investors that are doing the homework. I like that a market is getting corrected. I think certain stocks have been, lowered significantly, some more than others. I just showed in the Magnificent Seven, there was a pretty drastic difference between the stock that lost the most value and the one that lost the least amount of value. And that really plays out in smaller cap stocks too. So I'm looking for stocks that have really good value at the current time, maybe have been avoiding the radar and are good companies that are really operating really well at the current time, but just have been overlooked because they're smaller companies. I'm also looking to invest in the Magnificent Seven. They are excellent companies. And if you buy them at the right time, they're almost guaranteed, appreciation vehicles. So I'm always looking at the Magnificent Seven as well as other stocks that are worth investing in. Do me a big favor and like my video and subscribe to my channel. That'd be a big help. and I could continue to produce videos like this, and you would know when I created a new video. With that, good luck investing in 2023.